Hi, my name is Hussein Isa. Today I will be discussing the problem of duplicate records in databases. What are the causes that lead to their existence, the implications of duplicate records, and the detection techniques that can help us identify them. I will first start by introducing the problem in general, then discuss duplicate records and their causes, process, and methods used to detect them. After that, we will focus on duplicate payments, which is a problem of special interest to the business world. And then we discuss the methodology used in this study and the findings before we conclude with a brief summary. With business electronization and globalization, the increased use of information technology in businesses, all this led to the generation of huge databases. The sizes of databases moved from small megabyte databases to huge warehouses. Moreover, data is collected from different systems and from different locations, sometimes from different countries for the same company. All this has increased the importance of data quality. In fact, data quality has become a key issue in computer-based management systems. Inadequate data causes serious operational difficulties as well as direct financial losses. Operational databases store information generated by business transactions, and this information is used by management to support business decisions. What complicates the matter is that in most situations, again, this data is collected from different systems, and those systems, they are not the same in most of the time, in that they have different schemas, different structures for databases, and sometimes even different formats. And this data quality will affect the systems and will affect the decisions of the management if those decisions are based on this data. For example, the data quality. The quality of the data can be affected by several errors or types of errors. It could be a lack of constraints, like the age of a certain person would be 435 years instead of 35 years. So if there are no constraints on the age, any number could be entered. It could also be an unintentional human error, like typing mistakes, data entry errors. It could also be lack of standardized database structure or format. It says especially when it's gathered from different sources. Take, for example, the date format or the address format, whether you're going to use only the full name of the address, or just like street could be ST. We will talk about that a little bit later on when we discuss duplicates and the causes of duplicates. In this study, what we are trying to answer is the following question: how can we apply a rule-based system to identify duplicate records? What we're trying to do here is to determine the optimal combination of variables that can lead to uniquely identifying each transaction, and that if a transaction is found based on those variables is found more than once, it is a duplicate. This study, it brings from the computer science literature algorithms and techniques that can also be applied to a business problem, more specifically to an accounting problem. And in this study, one of the contributions is that we use a real business data set. Before we discuss duplicate records detection, we need first to define what duplicate records are. According to Weiss et al., duplicate records are all cases of multiple representations of the same real-world objects. In other words, It's this existence of the same vendor or invoice or payment or supplier or employee in the same database in the data source more than once. This problem is not a new one. The issue of duplicate records has been discussed in academic and applied computer science literature for many years and decades. Although this is not a problem unique to computer-based processes, it tends to be more pronounced in automated systems. For once, the amount of data generated from automated systems is a lot larger than non-automated systems or manual systems in the previous days. The first concerns raised about duplicate records regarded medical records used for epidemiological researches. Other sections of society became concerned with this issue, such as tax agencies who wanted to gather information about taxpayers with missing or incorrect social security numbers. Duplicate record detection was also found to be a very useful tool to detect fraud and money laundering. So, like we mentioned before, although it could happen due to unintentional human error, however, it could also identify and help detect certain types of fraud. Duplicate records, sometimes also known as record matching or record linkage, there are several techniques that are used in order to detect such duplicates. Most of them are they use domain-specific algorithms, and by domain-specific algorithms we mean algorithms that target a certain area. Very few are more general. However, they still expect human knowledge or expert knowledge to be provided at the end of the detection process. Now, what causes duplicate records? There are several reasons where duplicate records can exist in a database. First of all, in an ideal situation, we would expect each data item to have a global or unique identifier, allowing these records to be identified, linked, and related across tables and systems. A unique identifier could be several variables or one in certain cases. However, it should uniquely identify each record in a way that it should only be found once. Unfortunately, many organizations have multiple data collection systems, such as SAP, Oracle, legacy systems. And all these systems, it may differ not only in values or identifiers, but also in format, structure, and schema of databases. Additionally, data quality is affected by human errors, such as data entry errors, lack of constraints. It could mean also intentional errors, and by that we mean certain types of fraud. Take, for example, the table we have here. John Smith. This is a simple format difference. John Smith at 1 Washington Park. It could also be entered as J.B. Smith, 1 Washington Park, J. Smith, 1 Washington Park, John Smith at 1 Washington Park Ave, and John Smith at 1 Washington Park Avenue. Now, when we as human, when we read or when we look at this table, we immediately know that this is the same person. However, for a system, those are 5 different records. So if system A uses the format John Smith at 1 Washington Park, whereas system B just uses the first letter of the first name, J. Smith, at 1 Washington Park, that should immediately create a duplicate record. Now this is not only another example would be like the date format. Take the date format in the US versus a date format in Europe, where we have the month, day, and year, as opposed to day, month, and year in Europe. And a system, if you look at the system as 10/6/2012, in the US this is October 6, whereas in Europe this is the 10th of June. Now that being said, many multinational corporates, they collect data from sources all over the world, and such problems can lead to the creation of multiple records or duplicate records in a database. Weiss and Naumann describe a generalized framework for duplicate records detection, which consists of 3 phases. Phase 1, candidate description. This is when we decide on which objects are to be compared with each other. For example, there's no point in comparing the name of record A to the address of record B, so we need to compare the names of the vendor from record A to the name of the vendor from record B. The second phase is duplicate definition. This is when we decide on the criteria based on which 2 duplicate candidates are in reality duplicates. These are the attributes that are considered relevant in the identification of duplicate records. So for example, you decide that for record A and record B to be duplicates, those are candidates. Candidate A and candidate B to be considered as duplicates, you need to compare, they must have identical or similar name, address, date, and amount. This is, for example, for duplicate payments. Say we have 2 payments, A and B. Payment A, we have the vendor, the date, the amount from record A must be similar or identical to the ones from record B. The third step is duplicate detection. This is when we actually run the algorithm and identify candidates and the duplicates. This is when we specify how to detect duplicate candidates and how to select and identify the real duplicates. It consists of 2 steps. So the first step is when we search for records, whether it was pairs, like triples, quadruples, etc., depending on the number of candidates, and then we designate them as candidates. Now, based on the criteria and definitions from the first 2 steps of phases, which are the candidate description and the duplicate definition, based on those the criteria from those 2 phases, we designate those records as candidates and the duplicates or not. Usually there are 2 main approaches for the first step, which is searching for record pairs or record triples. The first one is blocking, where the entire dataset is divided into segments or blocks, which contain records with the same values for a set of attributes. The second approach is sorting the database. This is when we look at the candidates of duplicate records in small regions of the database. In other words, only neighboring records. We expect, after sorting the data and the records, we expect similar records to exist neighboring each other or near each other. A variation of this approach uses a sliding window technique. This is when we fix the window and we kind of slide it. We move across the database. There is, however, a trade-off between the accuracy of the algorithm and the size of the window, which decide which decides on the number of records to be compared. The larger the window size, the more accurate the detection process is, however, at a greater computational cost. In fact, in order to capture all the duplicate records, we would have to compare all possible pairs of records. And that is prohibitively computationally expensive, and it's not usually feasible in when the databases are large. So the first step was to search for record pairs. The second step in phase 3 is when we match them. This is where the possible duplicates that were identified during the searching step are compared. And they are actually compared, and then they are classified as matching or non-matching. We can either use a probabilistic approach, which assumes the matching non-matching patterns to be known in advance, or a machine learning and statistical technique model based, for example, on decision tree. Before we forget, the first two steps can be done offline, and those are candidate definition and duplicate definition. This is when those can be done offline before we start the actual running the actual algorithm, and those can happen or can take place during system setup. The third step must take place when the actual detection is performed and the algorithm is run. There are two ways of duplicate detection. So the first method is exact matching. The second one is fuzzy matching. With exact matching, the two records in a data set must be identical in all fields, in all the fields that we are comparing. So record A and record B must have the same. Let's say we have two payments again, payment A and payment B. They must have the same identical amount, the same identical vendor, the same identical address, same and the same date. So say also take the table below when we have John Smith. So if we have, for it to be considered as exact matching, it has to be entered as John Smith, 1 Washington Park Ave, and John Smith, 1 Washington Park Ave. It has to be exactly identical. On the other hand, fuzzy matching or near identical matching, the two records do not have to be identical. However, they must have similar values for certain relevant fields, for the fields that we are looking at, for the criteria that we defined in phase 1 and 2. Now, those usually they can occur due to several errors. This is when we could have like a different value format. Again, look at the date. We could have it as October 24, etc. So those, if it's entered, the system may read them differently. And usually the duplicates are classified or categorized as duplicates or non-duplicates based on a threshold and some similarity criteria. Some of the most popular similarity criterion is the Levenshtein distance, which measures the minimum number of edit operations, and that would be insertion, deletion, or replacement needed to transform record A into record B. For instance, the distance to change record 1, 2, 3, 4, 5 into 1, 2, 3, 4, 8 is 1. In the table below, we have John Smith, 1 Washington Park Ave, and John Smith, 1 Washington Park Avenue. The distance is 3 because it's enough to add 3 more to make 3 changes to the second one, or to the first one, or to be identical to the second one. Other more sophisticated distance measures or similarity measures. They take into consideration the gaps, and that would be good for this is called, for example, the affine gap distance. There's also the Smith-Waterman distance, which assigns higher cost to the mismatches in the middle as opposed to the extremities. In this case, this is important whenever we have prefixes and suffixes. So in that case, if you have Mr. John Smith, the Mr. would have less weight than John Smith. Now we are going to talk about one specific case of duplicate records which is of special interest in the business world, and that is the problem of duplicate payments. Due to the change in the nature of businesses and the increased use of information technology and more automation and electronization of businesses, all this led to the generation of large data sets. So with the progressive evolution of information and telecommunication technologies, the conversion from traditional paper-based processes to more digital and automated processes took place. This evolution encompassed accounting information systems which generated, computed, and analyzed, and also stored transactional level data. And with transactional level data, the size of data warehouses exploded. Large amounts of data is being stored at the most granular and most disaggregate level. Many systems were developed to take advantage of the existence of these existent large databases. For instance, it became common for companies to implement information systems ranging from simple automated accounting packages to the complex enterprise-wide ERP systems or enterprise resource planning systems. Other companies implemented and deployed decision support systems which take advantage of the collected data in order to help management and human users make decisions. And knowledge-based expert systems is another type of systems that have become popular recently. Those are the KESs, and these systems, they assist auditors in audit processes and help them detect fraudulent activities, to identify certain patterns and anomalies. Now, of course, the quality of the output of these systems, the quality of the decision made using a decision support system will depend on the data that was fed to that system. There is a well-known concept in information technology that is called garbage in, garbage out. And by that we mean whenever you input garbage or low quality data, the output will be of low quality. This is especially the case because we have multiple systems and we have the data is collected from different sources. It's collected from ERP systems, legacy systems, and even even if you have like one ERP system, say SAP, in most of the cases you would have multiple instances, and each instance would maybe configured differently. Whenever a company that has an ERP system acquires a different company A with an ERP system acquires a company B, it would inherit with it the legacy system that was used. The ideal situation would be for the acquiring company to migrate the accounting system to an ERP system, to the same one, so that it would be all over across the enterprise. Unfortunately, this is not the case in real life because switching to ERP systems is costly, and most of the time companies end up with a lot of legacy systems and ERPs, etc., that would feed into the data warehouses. So duplicate payments can be caused by several, or can result from several types of errors of problems. So for example, they can be caused by simple human errors, like a typing mistake. You would add a 0 at the end. They could also be the result of object representation. For example, you pay a check to Rutgers versus Rutgers University. It could be a problem with the format, like we saw in the previous slides when we talked about date formats. It could be like a systematic error, like structures. And of course, it could indicate collusive fraud. Now, the problem of duplicate payments is that it costs immediate financial losses. And duplicate payments is not a rare event. Actually, it happens more often than you would think. People think that because they have ERP systems, the system or the internal controls would automatically prevent such an event from happening. It would automatically prevent duplicate payments. The problem is that, again, we go back to the multiple sources of data, and the same payment could be made from within the same company from two different departments or divisions that may be using different accounting systems. Medicaid identified more than $9.7 million in duplicate payments in a 2-year audit period, and estimated the actual amount to be around $31 million. Another example is when there were 2 duplicate payments, which amounted to $1.08 million, and that was discovered by the Department of Veteran Affairs. These duplicate payments, unfortunately, very often they go undetected because they are hard to find, and especially across systems. This is why it is of great importance to implement certain techniques that would help in their identification and their detection. Actually, there are some commercial agencies and some companies that they are called sometimes bottom scrapers. They would contact companies and provide their services for a percentage of all the amounts that they detect. So they don't get paid a lump sum. However, they get, let's say, 40% of everything, for all the duplicate payments that they can detect. The data used in this study belongs to a telecommunication company. It's a multinational telecom company, and the data that we got comprised of 2 separate files that were extracted from 2 non-overlapping data sources. So each system, in other words, each data set was completely separate and completely independent from the other. Both data sets covered a period of 2 years, from July 2008 until June 2010. Dataset 1 included information on payments to telecom carriers. It had 21,606 records in total, and it had 8 variables or attributes. Dataset 2, it included information on payments made by checks, and it contained 47,683 transactions. This one had 51 variables. In order to use any data set, usually we need to validate this data. We followed the validation method described by Kimball and Caserta, which consisted of 3 steps. The first one was parsing, where we identified all the individual elements in the data set. And the second one was data transformation. This is where you need to rename a certain field, change the format, and convert an element from one type to the other. And sometimes you may compute a new field. And we have also data standardization, where we would use the same format. So for example, you would change the dates or the addresses to follow the same format in the whole data set. Now, like we said, we followed that validation process, and for data set 1, we did not need to do any transformation. The data was clean, it didn't have any missing values, and it had practically clear and self-explained attributes. And the data was used almost immediately. We just needed to clear out certain attributes, and we contacted the company who provided the necessary explanation. For dataset 2, however, we needed that dataset needed to undergo multiple transformations and different changes. First of all, it had many redundant attributes. For example, we had attributes that talked about the amount paid, the applied amount paid, the check paid, etc. So all these, although they are different, they still convey the same kind of similar information. So it was not necessary to include all of them in the study. And many of them, they had a lot of missing values. So also those ones had to be filtered out. Some attributes also did not directly relate to the problem at hand, which is duplicate payments. Now, again, like we said, we needed to do some standardization, like for the date and amount, because of inconsistencies in their formats. We used 2 software applications for this study. We used Excel for the manipulation of data, and then we used ACL for analysis. We used several combinations for this study. We followed the generalized process that was described before, and the algorithm that was used in the 3rd phase, which is the duplicates detection phase, we used for dataset 1, we used a 3-way match algorithm. We used exact matching, and here we used the amount, the date, and the vendor. Keep in mind that here by amount, date, and vendor, we mean the concept of the amount, the concept of the date, and the concept of the vendor. And for dataset 2, we had to include a fourth variable. We use a 4-way matching, which is the amount, date, vendor, and invoice number. For evaluation purposes, we used precision, which is true positives over true positives plus false positives. Precision is a measure that is used to measure the correctly identified duplicates over all found duplicates. True positives are those are transactions or records that were flagged or classified by the system by the algorithm as duplicates, and they were in fact duplicates. whereas false positives are the cases where the system identified them as duplicates, however, they turned out to be legit and not duplicates. The results from the algorithms run for dataset 1 were somewhat interesting. So we used several combinations. For the first combination that we used was the carrier name and ID, which indicates the vendor ID, the effective date, and the amount. This combination and this algorithm yielded 82 candidate duplicates. When we used the entered date, the number of candidate duplicates went up to 168. After consulting the company, it turned out to be that all the 82 candidate duplicates were part of the 168 from the second combination. We tried including payment ID. Usually the results are supposed to be 0 candidates, and that was the case in here. As expected, most of these results turned out to be false positives, which is to mean they were flagged as candidates, however they turned out to be legit and not duplicates. But the company, the company auditors, they confirmed that some of these records were indeed duplicates. Well, the reason why we sometimes have false positives is that simply the data sets that we have are not complete, and it could be an omitted or missing variable that we don't have in our data set. Once included, it would lead to the identification of those duplicates, or to flag them as non-duplicates. Here we came across an interesting finding. It was a little bit surprising actually, because we found 3 cases where the payment was categorized as commission payments, and keep in mind that this company does not allow commission payments. So according to the company's policy, those should not have been there. They should not have been in the system. However, they were there, and we informed the company about that. So after investigation, the auditors came back to us and informed us that those commission payments were still in the drop-down list under check payment. So for transaction type, instead of choosing check payment, or it was commission payment. And this is one of the things that you come across in certain cases where you just find that this data, the quality was affected by a simple error, because this type of payment was supposed to be removed completely from the system. However, that was not the case. And this is one thing that also adds to the improved quality of the data, because in this case, whenever you run this type of analysis, you can identify other errors and systematic errors that can be cleaned and removed and fixed. In this case, it would improve the overall quality of your data. For data set 2, we first used a 3-way match using the date, the amount, and the vendor name. However, that yielded over 24,000 candidates, which is not, in a way, it's not reasonable to have all these. And so we included a 4th variable, which was invoice ID, and still it yielded 33 candidates. Usually when you include the invoice ID, you're supposed to have 0 candidates, as was the case in the previous that was in the previous data set. Invoice ID here is equivalent to the invoice number, and it's supposed to be, like in most cases, a unique identifier of their records. Unfortunately, once again, because of multiple data sources, in certain cases, let's say, or from different vendors, the invoice ID number can be a duplicate. Here also we came across another interesting finding where over 13,000 records from those 47,000 records, over 13,000 were customer refunds. And we gave this information to the company because that could either indicated a problem with their business model, or it could have indicated some kind of foul play or fraud. To sum up with what we have said, globalization and electronization of businesses have led to most businesses and companies relying on databases. Systems have been developed to handle and effectively take advantage of these databases. The use of automated audit and fraud detection systems has become popular in the business world. However, the output quality of all these systems remained largely dependent on the quality of the underlying data. So it is of great importance to make sure that the quality that is being fed to those systems is of high quality, especially when we use this data for decision making, whether it was management, auditors, or other users. And one particular problem is duplicate payments, which is more aggravated by, or let's say like duplicate records in general, and duplicate payments more specifically, which is aggravated by multiple sources feeding into the same data warehouse, which is used eventually for decision making. So in this case, it's not enough to rely on the controls in each system. We cannot look at each system individually. We have to come up with new ways of identifying the overall systems. And those duplicate payments, they can arise from fraud or systematic errors or simply human errors, unintentional errors. They could also be the result of multiple systems, such as like different database schemas and structures or formats. And duplicate payments can have serious effects on the quality of audit and fraud detection systems. In this study, we applied a rule-based system to a real business payments dataset, two real business datasets from a telecom company, in order to identify duplicate payments using a 3-way and 4-way exact matching algorithms. The results show that although ERP systems are effective and can limit the existence of duplicates, they are not foolproof, especially in cases where data is collected from multiple systems. For future research, we intend to use more sophisticated algorithms. Instead of using exact matching, we would like to use fuzzy matching, where we would try to identify split payments. Those are payments that were paid in half in order to camouflage the duplicate intentions, like the intentions of paying duplicates. And we would also like to develop a methodology that would help us in prioritizing the identified duplicates, which, as the results show, tend to be numerous and too numerous actually to investigate to investigate all of them. So we would like to develop some kind of technique or methodology that would allow us to identify patterns, maybe based on geographical location, on the frequency, the users who use those ones, This would help us focus our attention on the more suspicious and more likely duplicates as opposed to regular duplicates. Thank you for listening, and I hope that you enjoyed this lecture.